The language of the stock market is designed to be confusing. In the next few minutes, we are going to decode every single term you need to know. Stock. A stock represents a share of ownership in a single company. If you own a stock, you own a small piece of that business. Shareholder. A shareholder is a person or institution that owns at least one share of a company's stock. You are also known as a stockholder. Stock exchange. This is the marketplace where stocks are bought and sold. Examples include the New York Stock Exchange, or NYSE, and the Nasdaq. Public company. A company whose ownership is distributed among general public shareholders through freely traded stock shares. Bull market. A period of time when financial market prices are generally rising. The trend is consistently upward. Bear market. A period of time when financial market prices are generally falling. The trend is consistently downward. Volatility. A measure of how quickly and how much the price of a stock moves up and down. High volatility means large price swings. Volume. The total number of shares of a single stock that are traded during a particular period of time, usually one day. Capital. A broad term for a financial asset or the value of a financial asset. It can be cash or other assets owned by an individual or company. Liquidity. The efficiency with which an asset can be converted into ready cash without affecting its market price. Bubble. A market situation that occurs when prices for an asset rise far above its real value, driven by optimistic speculation. IPO, initial public offering. The process where a private company first sells shares of its stock to the public, becoming a public company. Dividends, a portion of a company's earnings that is paid out to its shareholders, usually on a quarterly basis. Blue chip stocks, stocks of large, well-known and financially sound companies that have a long history of reliable performance. Portfolio, a collection of all the investments owned by an individual or institution. It can include stocks, bonds, and other assets. Holdings, a term for the specific contents of an investment portfolio. Interest, the payment made for the right to use another's money. When you lend money, you earn interest. When you borrow, you pay it. Bond, a loan made by an investor to a borrower, such as a company or government. The borrower agrees to repay the loan at a future date with interest. Security, a general term for any tradable financial asset, such as a stock or a bond. Broker, a person or company that acts as an intermediary to buy and sell securities on behalf of an investor. Going long, the simple act of buying a stock with the expectation that its price will increase over time. Asset, a resource with economic value that an individual or company owns with the expectation that it will provide a future benefit. Commodity, a basic good or raw material, such as gold, oil, or wheat, that is interchangeable with other commodities of the same type. Yield, the income return on an investment. This usually refers to the interest or dividends received from a security and is expressed as an annual percentage. PE ratio, price to earnings ratio, a valuation ratio that compares a company's current share price to its earnings per share. Index, a method to track the performance of a group of assets in a standardized way. The S&P 500 is a famous index tracking 500 large US companies. Futures, financial contracts that obligate the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and price. Options, contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. ETFs, exchange-traded funds, a type of security that involves a collection of securities, such as stocks, that often tracks an underlying index. IRAs, individual retirement accounts, an investment account that allows you to save for retirement with tax-free growth or on a tax-deferred basis. Penny stocks. These are shares of small public companies that trade for very low prices, typically less than $5 per share. They are considered highly risky. Market cap, market capitalization, the total value of a company in the stock market. It's calculated by multiplying the current stock price by the total number of outstanding shares. Leverage, the strategy of using borrowed money to invest. Leverage can amplify both profits and losses, and it significantly increases risk. Balance sheet, a core financial statement that provides a snapshot of a company's financial health, listing its assets, its liabilities, and its owner's equity. Inflation, the rate at which prices for goods and services rise, which causes the purchasing power of a currency to fall over time. Bid, the highest price that a potential buyer in the market is currently willing to pay for a share of a stock. Ask, The lowest price that a potential seller in the market is currently willing to accept for a share of the same stock. Bid-ask spread. This is the small difference in price between the bid and the ask. Transactions happen when the buyer and seller agree on a price within this spread. Earnings per share, EPS. The portion of a company's profit that is allocated to each outstanding share of its stock. It serves as an indicator of a company's profitability. Fundamental analysis. The method of evaluating a security by attempting to measure its intrinsic value. It involves examining a company's financial statements, management, and industry. Technical analysis. A trading discipline for evaluating investments and identifying trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. Supply and demand. The core economic principle that determines the price of assets. High demand with low supply leads to higher prices, and vice versa. This video is your foundational dictionary, but if you're ready to turn these definitions into a powerful, step-by-step strategy, that's the entire purpose of my book, Investing for Beginners. It's designed to be the practical roadmap that takes you from this core knowledge to building your very first investment plan, intelligently and with confidence. You can get it on Amazon by scanning the QR code on your screen now, or by using the link in the description below. Black swan. A term for an extremely rare event that is far outside what is normally expected and has severe consequences. These events are impossible to predict. Dead cat bounce. A temporary, short-lived recovery in the price of a declining stock, which is immediately followed by a continuation of the downward trend. Whales. A slang term for investors or institutions that have such a large amount of capital that their buying and selling decisions can make significant waves in the market. Unicorns. This term refers to a privately held startup company that has achieved a valuation of $1 billion or more. To the moon. Slang for a stock or other asset whose price is rising stratospherically, seemingly on a vertical trajectory, often very quickly. Tanking. The exact opposite of to the moon. This slang term is used when a stock's price is depreciating in value, often significantly and quickly. Jigged out. This slang describes a frustrating situation where a trader sells a position as it moves against them, only for the market to immediately reverse and rally to where the trade would have been profitable. Pump and dump, a form of securities fraud. It involves artificially inflating the price of a stock through false positive statements in order to sell cheaply purchased stock at a much higher price. Rug pull. This is a type of scam, common in the cryptocurrency space, where developers abandon a project and run away with investors' funds. Panic selling. A widespread sell-off of a stock, sector, or an entire market, driven by fear and overreaction rather than a reasoned analysis. Shorting, short selling. An investment strategy that speculates on the decline of a stock's price. It involves borrowing shares, selling them, and then buying them back later at a lower price to return them. Short squeeze. This occurs when a stock's price unexpectedly increases drastically. The investors who were shorting are then forced to buy back the stock at a loss to exit their positions, which drives the price even higher. Limit order. An order placed with a broker to buy or sell a stock at a specific price, or better. A buy limit order will only execute at the limit price or lower. Stop loss order. An order placed with a broker to sell a specific stock once it reaches a certain price. It's designed to limit an investor's loss on a position. Market order. An order to buy or sell a stock immediately at the best available current price. It prioritizes speed of execution over a specific price. Good till cancelled. GTC order. An order to buy or sell a stock that remains active until the order is either filled or the investor cancels it. Day order. An order to buy or sell a stock that automatically expires if it is not executed by the end of the current trading day. Averaging down. An investment strategy that involves an investor purchasing additional shares of a company after the price has dropped, lowering the average purchase price of their total holding. Fading. A contrarian trading strategy that involves trading against a prevailing market trend. Fading the market means selling when prices are rising and buying when they are falling. Hedge fund. A limited partnership of private investors whose money is managed by professional fund managers using a wide range of complex and often high-risk strategies. Mutual fund. A type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks and bonds. They are operated by professional money managers. Index fund. A type of mutual fund or ETF with a portfolio constructed to match or track the components of a financial market index, such as the S&P 500. Day trading. A fast-paced trading strategy where an individual buys and sells stocks within the same trading day, aiming to profit from short-term price movements. Swing trading, a medium-term trading strategy where positions are held for more than one day but typically not longer than a few weeks or months, aiming to profit from larger price swings. Value investing, an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. Growth investing, an investment strategy focused on buying stocks of companies whose earnings are expected to grow at an above-average rate compared to the overall market. Dollar cost averaging, the strategy of investing a fixed amount of money into a particular investment at regular intervals, regardless of the share price. Compound interest, the process where you earn interest, not just on your original investment, but also on the accumulated interest from previous periods. Profit margin, a percentage that represents a company's profitability. It is calculated by dividing the company's net profit by its revenue. Return on investment, ROI, a performance measure used to evaluate the efficiency of an investment. It is the profit from an investment relative to its cost. Ticker symbol, a unique abbreviation, typically of 1 to 5 letters, used to identify a publicly traded company on a stock exchange. For example, AAPL for Apple. Insider trading, the illegal practice of trading on the stock exchange to one's own advantage through having access to confidential information that is not available to the public. Control stock, shares owned by major shareholders of a company who have a significant enough stake to influence the company's decisions. Holding company, a type of company that doesn't conduct any operations of its own, but instead owns a controlling stake in other companies, known as subsidiaries. Forex, foreign exchange, the global marketplace for trading the currencies of different countries against each other. Liability. In financial terms, a liability is something a person or company owes, usually a sum of money. It is a financial obligation, long squeeze, the opposite of a short squeeze. This is a situation where a sudden drop in a stock's price triggers a cascade of stop loss orders from long positions, forcing investors to sell and driving the price down even further. Intrinsic value, the perceived or calculated true value of an asset, based on fundamental analysis of its underlying financial health and potential, independent of its current market price. Book value, the net asset value of a company, calculated as its total assets minus its liabilities. It represents the value investors would theoretically receive if the company was liquidated. Price-to-book ratio, P/B ratio, a valuation ratio used to compare a company's current market price to its book value. Efficient market hypothesis, a theory that states that share prices reflect all available information at all times, making it impossible to consistently beat the market through stock picking. Call option, a specific type of options contract that gives the holder the right, but not the obligation, to buy an asset at a stated price within a specific time frame. It's a bet that the price will go up. Put option, a specific type of options contract that gives the holder the right, but not the obligation, to sell an asset at a stated price within a specific time frame. It's a bet that the price will go down. Subsidiary, a company that is owned or controlled by a larger parent or holding company. Actively managed fund, a fund, such as a mutual fund or ETF, where a professional manager or a team makes active decisions on which securities to buy and sell with the goal of outperforming the market. Passively managed fund, a fund that aims to replicate the performance of a specific market index. There is no active stock picking. The fund automatically holds the securities that are in the index. Stock split, a corporate action in which a company divides its existing shares into multiple shares to boost the liquidity of the shares. While the number of shares increases, the total value of the company remains the same. Reverse stock split, the opposite of a stock split. A company reduces the number of its outstanding shares, which increases the price per share but keeps the total market capitalization the same. Merger, the combination of two separate companies into a single new company. Acquisition, a corporate action where one company purchases most or all of another company's shares to gain control of it. Share buyback, a program where a company repurchases its own outstanding shares from the open market. This reduces the number of shares available, often increasing the value of the remaining shares. Gross domestic product, GDP, the total monetary or market value of all the finished goods and services produced within a country's borders in a specific time period. It's a broad measure of a nation's overall economic activity. Interest rate, the percentage of principal charged by the lender for the use of its money. Central banks, like the U.S. Federal Reserve, set key interest rates that influence the entire economy. Recession, a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. Diversification. The strategy of investing in a wide variety of assets to reduce the overall risk of a portfolio. It is the principle of not putting all your eggs in one basket. Asset allocation. The implementation of an investment strategy that attempts to balance risk versus reward by adjusting the percentage of each asset in a portfolio according to the investor's risk tolerance and goals. Risk tolerance. An investor's ability and willingness to endure potential losses in their portfolio. It depends on factors like age, financial goals, and personal psychology. Securities and Exchange Commission, SEC. In the US, this is the government agency responsible for protecting investors, maintaining fair and orderly markets, and facilitating capital formation. Brokerage account. An investment account that allows you to buy and sell a wide range of securities, like stocks, bonds, and ETFs. It is your gateway to the financial markets. Custodian. A financial institution that holds customers' securities for safekeeping to minimize the risk of their theft or loss. Your broker typically acts as the custodian. Execution. The completion of a buy or sell order for a security. When your order is executed, the transaction is complete, and you have officially bought or sold the asset. Trading session. The official hours during which a stock exchange is open for business. For example, in the US, the regular trading session is from 9:30 a.m. to 4 p.m. Eastern Time. After-hours trading. Buying and selling of securities that takes place after the major stock exchanges have closed. This type of trading often has lower liquidity and higher volatility. Margin. A type of account that allows an investor to borrow money from their broker to purchase securities. Trading on margin uses leverage and significantly increases risk. Margin call. A demand from a brokerage firm to an investor who is using margin to deposit additional money or securities so that the margin account is brought up to the minimum maintenance margin. Real Estate Investment Trust, REIT. A company that owns, and in most cases operates, income-producing real estate. REITs allow individuals to invest in large-scale properties in a similar way to stocks. Emerging markets. Nations with social or business activity in the process of rapid growth and industrialization. Investing in these markets offers high potential growth, but also carries higher risk. Capital gains. The profit that an investor realizes when they sell a capital asset for a price that is higher than the purchase price. Dividend yield. A financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's a measure of the dividend-only return of a stock. Blue sky laws. State-level, anti-fraud regulations that require issuers of securities to be registered and to disclose details of their offerings. They are designed to protect investors from fraudulent schemes. Arbitrage. The strategy of simultaneously buying and selling an asset in different markets to take advantage of tiny differences in the asset's listed price. Beta. A measure of a stock's volatility in relation to the overall market. A beta of 1 means the stock moves with the market. A beta greater than 1 is more volatile. Less than 1 is less volatile. Alpha. A measure of the performance of an investment on a risk-adjusted basis. Alpha is the excess return an investment generates compared to a benchmark index. A positive alpha means the investment performed better than its benchmark. Expense ratio. The annual fee that all funds or ETFs charge their shareholders. It is expressed as a percentage of the fund's assets and covers the fund's operating expenses. Lower is better. Fiduciary. A financial advisor or institution that is legally and ethically bound to act in the best interest of their clients. This is the highest standard of care in the financial industry. And there you have it. From alpha to yield, we've covered the essential language of the financial world. And now you have the foundation to watch the news with new understanding, to read financial articles with clarity, and most importantly, to continue your own financial journey with confidence. The goal was never to memorize every single term. It's to remove the fear, to show you that the world of finance is accessible, and you are fully capable of understanding it. Since you've stayed until the end of this masterclass, it's clear you're committed to building your financial knowledge. And I think you'll find the videos popping up on your screen now to be the perfect next step. They explore more fascinating financial topics that will challenge your perspective even further. If this video helped you, please like and subscribe for more content that breaks down complex financial topics. Thank you for investing your time.